Hello everyone, my name is Archita Bachani, student of BBA third semester. Today I am going to present on the topic of corporate formation, governance and capital market under company law. What is a company? A company is a legal entity formed under the Companies Act 2013 having a separate identity from its owners. This means the company can operate independently, enter into contracts, own property and continues its existence even if its members change. To regulate and control such companies, a proper legal framework is required, which brings us to the Companies Act 2013. The Companies Act 2013 is the main legislation governing the incorporation, management, regulation and winding up of companies in India. It replaced Companies Act 1956 with the objective of improving transparency, corporate governance and investor protection. The Act ensures companies operate in a fair, ethical and well-regulated environment. Based on this Act, companies are classified into different types. Under the Companies Act, companies can be classified as private companies, public companies, one-person companies, and startups. Each type differs in different terms of ownership, control, and capital requirement, allowing flexibility of businesses to different sizes. Once a company type is decided, the next step is corporate formation. Corporate formation is a legal process through which a company is created, registered under the Companies Act 2013. Through this process, a company gains a separate legal identity, limited liability, and the capacity to raise capital. Corporate formation is regulated by Ministry of Corporate Affairs through the Registrar of Companies. After the formation, it is important that companies are managed responsibly, which lead us to the corporate governance refers to the system of rules and practices by which a company is directed and controlled. It ensures transparency, accountability, fairness, and ethical management. Good corporate governance protects the interest of shareholder, builds trust among investors and stakeholders. Companies like Britannia Industries and Asian Paints follows strong governance practices which supports their long-term growth. These governance practices are guided by certain basic principles. The key principles of corporate governance include transparency, accountability, fairness, responsibility, and independence. These principles ensures ethical decision-making and balanced control within a company. To ensure these principles are followed, a regulatory authority plays an important role. The Securities and Exchange Board of India, or SEBI, plays a crucial role in corporate governance for listed companies. SEBI ensures transparency through mandatory disclosures, protects investors' interest, and regulates board structure. By doing so, SEBI promotes fair and ethical corporate practices. Now, let us understand the market where companies raise long-term funds. A capital market is a financial market where long-term securities such as shares and debentures are issued and traded. It mobilizes savings from investors and channels them into productive investments, supporting business expansion and economic growth. The capital market is divided into two main segments, primary and secondary market. The primary market deals with the issue of new securities such as IPOs and FPOs, where a company raises fresh capital, whereas the secondary market deals with the trading of existing securities, providing liquidity to investors. Finally, the companies uses different methods to raise capital based on their structure. Methods of raising capital. First, private companies raises capital through private placement and private equity funding such as Lenskart and Boat raised 8,000 plus and 1,000 plus crores respectively. Second, public companies raise funds from public through IPOs and FPOs like LIC and IRCTC raised 21,000 crores and 645 crores respectively. Third, one-person companies raises capital mainly through personal savings or bank loans. Lastly, startups raises funds from angel investors and venture capital firms such as seen in companies like Meesho and Swiggy raise 9,000 plus crores and 25,000 plus crores respectively. To conclude, Companies Act 2013 provides a strong legal framework for company formation and governance, whereas corporate governance ensures ethical management and investors' confidence, while the capital market enables companies to raise funds for growth. Together, these elements form the backbone of modern corporate sector in India. Thank you.